Hello, this is Martin from seekedge. Welcome to the Option Trading for the Beginner series. Today, we are going to discuss on a very interesting topic of the big debate between options buying versus option selling. The 10-point mythbuster. Let's dive into the facts. Options buying and selling myths. Some of the common myths that we debate on. Option buying is a low capital way of trading in the options, right? Option selling is unlimited loss and it is very high risky. Options always buying gives blockbuster returns, right? While selling gives very little returns. Selling is very complex. Buying is very easy to make money. Right? Don't we not seek answer to these facts? Don't we not debate based on our experience on whichever side it is? Are you ready for the mythbusters? Let's see the answers and the facts. These are the 10 points that we are trying to discuss on as a fact check. The skills, the efforts, the capital, the risk, win probability, reward versus risk, the direction, the time decay, volatility and discipline. These 10 facts I hope would give an answer to all that we are seeking for. Let's take skills as the first example. Option buying needs a higher and a different level of technical analysis is a fact, because getting the direction of the price movement right during a breakout or when the price is mean reverting, in both cases it's not easy. It's very difficult. Very often it requires usage of price action, several different indicators, and on top of these technical analysis skills, it also does need fast trading execution skills, which is more needed in the buying. Well, option seller also need to have skills. No, it's not that. But the level of the skill is not as much required. Definitely, a seller need to understand the fundamental concepts of option selling, right? But very often, what happens is the option Greeks like theta, vega, gamma, delta, all these complex names, right, makes him think that option selling is something that requires very high level of skills. But the reality is that academic level of mathematical science behind the option pricing is not really required fully to trade them well and make money. Ultimately, what matters is to make money. So that's about the skills. Efforts. Option buying actually seems to that it's not that difficult, but actually the fact is that it requires a lot of screen time. It requires a lot of stress and full involvement, active involvement. You need to be in front of the screens for a lot of time. You need to be patiently waiting for that signals based on your rules to come in before you make the trade entry right. And also you need to trade properly and exit at the right time, otherwise you lose all that you have gained in a matter of minutes. So it requires a lot of effort and you need to be in front of the screen a lot of time. Option selling, unless you are doing intraday option selling, right, it may not need as much of attention always, as long as we are having options as risk defined. Overnight positions are often risk defined, that we know this is the amount of risk, this is what you're going to lose max. Neutral option strategies has a wider range of price movements, so you don't need to panic no matter price moves across the standard deviations on both sides. You don't need to panic, right? You can set alerts for making the adjustments, right? So you don't basically need a full-time attention in the case of option selling. It's a fact, unlike what people think. Now, what about capital? Capital is the amount of the money that is required to play the game, to get into option buying or selling. Both needs capital. So the initial capital requirement for the option buying is very less, because it is just the premium that you pay that is required. This is the point that makes a lot of beginners in the optional trading get into optional trading itself. They go for buying because it's hardly costs 10,000 rupees for most of the stocks or the indices, right? 10, 15,000, 20,000, you are in the game, right? And the reason that market does not always trend, right? The market does not always, the market on a long-term cycle, if you see them, may be trending, but in a shorter time, if you dig in to lower time frames, you can see that it's not trending always. Majority of the time, most of the time, the trending does not happen. It would be moving sideways or consolidating, right? So there is a high probability of losing, right? That small premium amount by which we have made the option buying, that can, there is a high chance that even if you're right, you may lose it, right? And you keep on doing that because of the amount of capital required. And so say you have 1 lakh, you invested 10 lakh and you lost, next you gained, and then again you put in. So over a period of time, since the capital requirement is less, you would put in more money, and then eventually you will wipe out. Also, faster wipeout also can happen in the case of option buying if you are lacking the skills that is required, if you are not good in predicting the direction, right? It becomes much faster. If you scale up wrongly, you buy more number of lots, and then price gives a false breakout, then the capital gets wiped out faster also, right? So these are the facts that we ignore when we talk about option selling. Requires very little money to get it, right? Option selling margin requirements are very high. It's a fact, but it can be reduced by using the hedging, right? Which most of the most of the people don't know about that, right? So if you risk define your strategy and then put overnight positions, you know what the risk is going to be, and plus you get the margin benefits. You don't need to nowadays 35-40% of margin requirements is only from the actual as compared to an actual naked position is what the reality is. So making consistent return of investment, right, with high probability trades, with the small cap, with the large deployed capital, that is the key, right? Even though the capital is big, what matters ultimately is that for that deployed capital, do you get the returns, right? You put in less money, right, and then lose the entire one, is what option buying may be sometimes, most of the times for the beginners, unless you are skilled enough, right? So consistent return of investment of the capital is what matters ultimately. Let's move ahead and see the next point, that is a risk. Option buying has maximum loss risk, which is limited, right? The maximum loss, no, maximum how much you can lose if you take a trade, that is limited, right? It's not that it is not there, but it's limited to the small amount. But that small amount, as we saw in the last slide, consistently, slowly you will finish off that small amount, and then the big account would be clean, right? So option selling can also have limited risk rates. We already saw that. So risk can be reduced if if risk defined strategies are used. Option buying can also be very risky, right? We already saw how some of the reasons why, and you can use the entire premium if a direction is wrong and you're putting in more quantity or more lots into it. Say, since the capital is less, you took the leverage and then put in 20, 30, 100, 50, 200 quantity, and then you get hit, right? You take overnight positions, and the next day the time decay automatically happens, and then so the risk is there. Option buying probably more, right? You can lose out the entire small premium, right? Now option selling is heavily risky if you're not sure what you're doing. Now if you're not understanding the concepts behind it, right, and if you're not taking hedge positions and risk defined strategies, if you're not using it, then it's deadly. On top of that, as everyone says, the black swan events, the events like the exchange goes down, or there is a war breaks out, things like that. These are very rare things that happen, but these things can again clean your capital, wipe out your account, bust your account if they are naked without hedge positions. So heavy losses can happen, right? May happen in option selling. As in option buying, black swan events, your risk may be limited, but here also risk can be limited if you are putting risk defined strategies, which most of them don't do. So like whenever option sell is heard, those who have not learned it thinks that option learning is just selling it. No, right? So if you hedge positions, you don't need to worry that much on black swan events, because you know the worst case how much you lose, right? The risk is defined, then this also black swans also does not impact that much, right? Now what is the probability? The option buying has lesser probability of winning, right? Most of the times, right? Probability is what, no? If you see the normal distribution systems that we have studied, the bell curves, we know that, no? Majority of the time the market does not trend, right? It will be moving sideways. So it breaks out only very rarely. It's the trending of the price movements, breakouts does not happen very often, very rarely, right? There is a less chance. Most of the time it will be in the middle portion. That's where we don't make money. So imagine option buyer who is losing the premium because of the time decay, right? So whenever it happens, you just should not exit with small profits. You just have to write that. So the probability of winning is less. So the win percentage of the trading strategies for option buying, if you see, maybe 35-40, but still he may be profitable. Successful traders with option buying have made a fortune out of this 35%, because they ride the trend whenever there is a bust, a breakout. There is a breakout of the price that happens. But option selling has higher probability on each trade. Take more number of high probabilities trades and make small wins. That's the philosophy behind option selling. This is because the neutral option selling strategies are based on a range of the price movements, right? So the probability of that range, getting broken is not that. It's not that easy to break that. The percentage most of the time, if you statistically, according to statistics, if you see, right, it does not break that often, right? So as long as it is within that range, the option seller makes money, but so the probability of breaking that is less. So the direction of the price is not that very important, right? Now risk reward, if you see, the risk reward is lesser for option selling, right? But option buyer most of the time makes, whenever he gets the signal right and gets the direction right, it's multi-bagger. The returns could be 30, 40, 50, 100. Typical example would be, expiry day option bank nifty trades. If you see, when the gamma explosion happens, the price moves 100, 200% to that level sometimes. So that is what attracts people towards option buying, but that does not work always, right? So if you look at the risk reward, it's huge. It's very good, often very good risk reward for the option buying. But strategies where selling is involved, the risk reward will be lesser. Right? You get only the premium, right? Only the credit. The option selling gives small risk reward and limited profits, but since probability is more, you may end up more consistent in making that small amount, right? Rather than losing it once big, right? So the targets often are return of investment based instead of the risk reward ratio, right? As in waiting till expiry date to meet, so you don't often option sellers with option risk demand options don't wait till the end of the expiry. Right? A lot of gamma effects, delta price movements, and all can happen during that time, so they exit much earlier. So they would also have a risk reward, but they don't go for the typical RR ratios for the option buying. So they look at what capital was deployed and how much percentage of capital for a week or a month is targeted, and whether it is achieved or not is what is. So the side you can see that there is a short straddle which is purely net credit based, and then which is purely selling. Although it has a two heads portions, you can see that it is giving a risk reward which is very less, but right. So let's move ahead and see the direction what is the direction, right? So the direction is the key thing, right? Finding the direction correctly is the challenge that the option buying is. Many times maybe false breakouts, right? So the win percentage, may not be that attractive very often for the option buyers. So what matters is to have a very small loss, and then once it direction is turned out, identified right, then just ride, don't book the profit, ride the trend, trail your stop losses, and that's what is known as a trend following system. So directional play. Option sellers, they're neutral trades. They did neutral trades, right? They also may be able to give some directional bias, but most of them, the major advantage of selling is that you can have neutral positions without knowing about the direction, right? So delta term used for the price. Delta is what is the Greek for the options price, right? Often works against the seller whenever there is a great delta movement. So it may break out the range and then you may lose out, right? Time decay, we had already talked about that earlier also. So the theta of the time decay in option selling will cause the premium price to erode as nearest to the expiry of the contract. So depending on the moneyness, whether it's in the money, out of the money, or at the money, right? So depending on that option, it's an options, but decay of the premium of the option is an option by a biggest enemy. On the contrary, theta or the time decay is the friend of option seller. That is what makes him money, right? When the value of the option premium falls down to the least, that's when he makes money. Therefore, overnight positions of option buying strategies should befriend the delta of the price movement and the vega. The volatility increases, price moves, and this mostly works in favor of the buyers. But the time decay is the biggest enemy for the buyer, where even if his direction is correct, he still may fall victim to the time decay, right? Now volatility is the next point. Volatility is the deviations from the standard, the price movement deviations from the from the mean, right? Option buying generally benefit from the volatility of the stock or the indices spikes, right? Option sellers benefit when the volatility falls down, right? This volatility is always mean reverting in nature. It goes up and after some period of time it falls down, right? That's the nature of it, right? So whenever the price is falling down, the volatility crush, what is known as, right? When the volatility mean reverse, that's when the option sellers actually benefit. Option buyers generally benefit when there is a spike in the volatility, when it is rising up. The premium prices may shoot up and then they gain, right? But it is mean reverting, so the same movement that benefited him can fall back after some time, right? So earnings trades, that whenever the earnings or the results, quarterly results of the companies are published, option sellers make a fortune, right? If they are trading it right. This is because of the volatility crush. Volatility, when it falls, it benefits the seller, right? So volatility can be looked upon in different ways. The same volatility can be beneficial for both, depending on what kind of trades that they are taking. The next and the most important thing is the discipline, right? Without discipline, you just cannot be into option trading. But the option buying requires much more discipline. Reasons for which we have seen, we already seen that it requires skills, it requires effort, attention, cannot be passive. Because of that, the discipline requirements are more. Right? Very often, it may be needed to wait patiently, very patiently, to get that signal right, even with all the interpreters. And if you are entering early and over trading, you are that's failure is guaranteed. So when the breakout happens, two things are very important. We already said that, right? You have to keep the take losses. You don't have you should not alter your stop loss. So you just have to take small losses, accept your loss as a happy loss, and then whenever it breaks out and you get the profits, don't be greedy to book the profit and then trail it. It's very easy to say, but very difficult to do in the reality, right? When the price moves up, there is a lot of stress. Moves down, there is a lot of stress. You may feel like extending the stop loss. Moves up, you may feel like booking and coming out of it. So this is very, very difficult, highly disciplined mindset is required. Option seller also need to be disciplined. All these factors are important, but not as much of stress comes in the case of option non-intraday players, because it does not need to be highly disciplined, with all the stress. That's all. That does not mean that option need not be disciplined. Discipline is always required. Rules has to be defined. It has to be systematic, rule-based trades. But right, if you look at, because you never know where the market goes, right? And if you're looking for the market in a direction, market often fails you, right? But if you're looking for market within a range, it's easier, right? So that benefit is there when it comes to the point. So that's why they are more common, composed mindset, right? Stress is there whenever there is an adjustment that needs to be done, and firefighting has to be done. Option sellers also do face stress, but not as much as, right? Yeah, so this is a summary, summary of the summary opinion that, there are three things, right? So identifying the trading type, it's option buying or selling, which one you want, and the trading style. It all depends on the person's character, psychology, emotional balance, and all of this. It varies with each person. There are n number of option buyers who make a fortune, who make a lot of money every day. But the same strategy and the same setup, if it is given to you, with your own capital, you just can't do it. So it's a lot of personality fitment. So it depends on what is your self-image, and what is in your belief, and what is inside you, right? Your mindset. So you have to decide which one fits in you, not others. Just because other person makes money does not mean that you can, right? So developing the skills, the knowledge, out of the conceptual knowledge of both things. If you're a buyer, the knowledge on that. If you're a seller, more, the knowledge on that, right? That's, and the experience in the real experience in doing that. Skill, knowledge, experience, and discipline. So these are the key things that is, second, that is required, other than, uh, the personality fitments. And the third one is, a combination of these strategies. As you mature as a trader, it's not necessary that you explore only your, one side of your personality and do only that. I'm a seller and I'll always be a seller. It's not necessary, because the market cycles keep changing. So having correlated, non-correlated strategies is very important. For example, you have neutral option selling strategies that will benefit from the time decay. So market always, most of the time, moves sideways. You benefit from that, make consistent small profits from that. At the same time, that market is trending, instead of just sitting there and then not trading. If you have strategies that are intraday break, that they can handle breakouts, right, and trend following systems, then have both, right? As you mature as a trader, that is where, it is, the reality is that, ultimately what matters is that you should be a consistently profit making. That's what matters. So these are the three, summary opinions that I have on this big debate of, which is the best for a trader, option buying or option selling. Thank you all. Happy trading and happy learning. Bye.